Welcome to the Pirls Stock Market Commentary video for September 25th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio rose to 1.54 from 1.23 last week, advancing within bullish territory. The total count of securities in bullish or bearish patterns decreased fractionally to 3,013. The count of bearish stocks decreased 13%, while the count of stocks in bullish patterns increased 10%. The Pirls PNF Market Breadth Summary Chart shows us a market now 13 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 42 points for the first decline in 8 weeks. At a positive 413.16 points, it continues below the August 2016 top, the April 2016 top, and continues above all remaining 3 tops above plus 100, and it continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up one higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. Now risen to a positive 146.16 from a positive 35.75 a week ago without forming a Woody's CCI pattern. The CCI 20 daily is outside the plus or minus 50 range required for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 21 weeks ago, while the daily CCI 20 began a Woody's uptrend 10 weeks ago. After the successful trade simulation last week, the CCI 20 weekly has risen to a positive 101.62 from a positive 77.05 last week, continuing outside the plus or minus 50 range for a new zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and REITs on top. Oil services, and banks on the bottom. Bullish, computer hardware and semis continue in the top 5. Oil services continues in the bottom 5. Oil has entered the bottom 5. REITs has left the bottom 5 and entered the top 5. Bearish, KBW Bank has entered the bottom 5. Gold and silver has left the bottom 5. Focus this week from www.zerohedge.com. Chinese contagion risks surge. banks' reliance on each other for funding hits all-time high. The following are some key points and charts. PBOC advisor Huang Yiping said that China's, quote, deleveraging isn't making progress, end quote, and that the, quote, high leverage ratio is becoming a big financial problem for the country, end quote. He notes that the, quote, leverage ratios in state-owned companies have kept growing since 2008, end quote. None of this is a secret. One look at the chart below from the IIF, according to which China's gross leverage is now roughly 300% of GDP, confirms just that. Claims on the government are surging up 80% and nearly CNY 7 TNYOY. As Soc Gen notes, the simultaneous and rapid rise in the PBOC's claims on domestic banks has raised questions as to whether China is conducting a modified form of quantitative easing. In our view, the surge in banks' claims on the government is because of the debt-to-bond program for local governments. These claims only include banks' holding of central government bonds and local government bonds. Any borrowing of quasi-government institutions from banks in the form of either loans or corporate bonds was and is still categorized as corporate borrowing. This means that it is the rapidly expanding swap program that enables local governments to issue many LGBs so quickly. Of course, this massive transfer of obligations to the government should mean that the local banks are more stable as a result of their liabilities being effectively insured by the government. Well, not necessarily. China's smaller banks have never been more reliant on each other for funding, prompting rating companies to warn of contagion risks in any crisis. Quote, contagion risks are definitely rising, end quote, said Liao Qiang, Beijing-based Senior Director for Financial Institution Ratings at S&P Global Ratings. Quote, the pace of the development is concerning, end quote. Of course, the rapid flight of deposits offshore is the biggest risk that has been facing China, and is why the PBOC has spent hundreds of billions in reserves over the past 18 months, trying to stabilize the yuan. In a sign that China's financial system has already moved beyond the Ponzi point on its way to the inevitable Minsky moment. Banks are also buying each other's wealth management products and accounting for the transactions as investment receivables. As a reminder, the Ponzi finance stage in a financial regime is where borrowers have insufficient cash flows to pay either principal or interest, and therefore must either borrow or sell assets to make interest payments. This is where China finds itself now. China joins the rest of the developed world in doing whatever it takes to keep its insolvent financial system alive by kicking the can as far as it possibly can. Thank you for watching this week's Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up, and wishing you true success.